Investors Chronicle.
Welcome back to the Companies and Markets Show, Thursday the 7th of July as we record, and so consequently a very happy Resignation Day to you, listener, and indeed to my IC panel here. We've got Alex Newman, Mark Robinson, Julian Hofmann and Dave Baxter coming up, all hosted by Dan Jones as normal. Hello Dan, what's coming up today?
Yeah, thanks, John. We have got Robert Walters in our Result of the Week, or Trading Update of the Week in this case. Then we're discussing this week's cover story, which is on our annual top 50 ETFs. And finally, we're going to look at some of the troubles facing Chrysalis Investment Trust and illiquid / unlisted assets in general.
Lovely stuff. Well, before we get there, a quick news roundup, and one place to start, and it's not directly in our Companies and Markets remit maybe, but it would be remiss of us not to note that Boris Johnson is to resign as Tory leader, following mounting pressure and a raft of cabinet resignations. He'll remain in number 10 until autumn, while a new Conservative leader is chosen. Neil Wilson commented that sterling was a smidge stronger on the news, but no real other significant market movements as of yet at time of recording. Elsewhere, according to Halifax, average house prices have hit a fresh record in June, despite worries the cost of living crisis would dampen demand. The average house price rose 1.8% to just under £295,000, the largest monthly increase since 2007. In companies news, we've had a gloomy Sainsbury's update. The supermarket reported 4% decline in like-for-like sales, excluding fuel, over the 16 weeks to June 25th. CEO Simon Roberts admitted the pressure on budgets will only intensify over the remainder of the year. Trainline, on the other hand, saw shares jump over 20% on Wednesday after it boosted its sales outlook for next year. The company said American tourists were leading the recovery of the European rail sector. Pub Group Youngs also revealed booming sales. Revenue was up 40% for the first 13 weeks of its financial year. Delivery company DX has dodged expulsion from the London Stock Exchange, saying its long overdue audit for 2021 will be completed by the end of September. The company was suspended from AIM in January after failing to publish its annual results on time. And an M&A line to finish, Spirax Sarco has begun talks to buy French industrial heating group Volcanic for around £226 million. Plenty more companies news to get your teeth into on the IC website and in the magazine as normal. But for now, back to you, Dan.
Thank you, John. Yes, we, as mentioned, we are starting with recruiters this week. Robert Walters had a trading update. Obviously, this is a keenly watched sector at the moment, not least because everyone is interested or perhaps slightly wary of what might be coming down the line for the UK economy. But as it stands, these companies have been doing pretty well. There are plenty of staff shortages around, not only in 10 Downing Street. So, Mark, you covered the trading update, and we've got a couple of full-year results from peers coming in a couple of weeks as well. What are your What are your takeaways?
I would say, looking at Robert Walters' figures, the trouble is that the full impact of the current economic problems aren't evident. It was a record second quarter for the recruiter as well, and the overall theme coming through the trading update was largely positive. But as I said, the question really is just how long the disconnect between the levels of economic growth and job creation will last. I guess what we're talking about there, or the real worry, is stagflation. Of course, that's when we get a combination between low growth and price inflation through the economy. We're already seeing this to a certain degree. The unemployment rate, of course, is one of the most reliable lagging indicators. So if the rate rose last month and the month before, it indicates the overall economy has been doing poorly and will probably continue to do so. Try and take some historical context where we are is probably illuminating in a sense. And when I was thinking mainly of the 1970s, it was mainly the last time that I used to buy music as well. But there was some sort of parallels. There was a high inflationary period there. You had, for whatever reason, government spending as a proportion of GDP spiking, not only in this country, but also, particularly in the US as well. And there was one-off reasons for this. The Vietnam War springs to mind. You also had a situation where oil prices nearly tripled. The real sort of parallel is the number of external economic shocks that we've had, both now and going back to that period as well. Chief among them, the soaring energy prices. Back to Robert Walters, of course, it was a very good trading update, and I think the company itself increased its headcount by about 7% to capitalize on the demand for talent. I mean, it's such a strange labour market at the moment because we're seeing skills shortages across a range of sectors, but particularly in tech sectors as well. And I guess one lesson that can be learned from the recruiters over the last decade or so, it's those that have that deal in specialisms and have also broadened their geographical footprint, which have performed better than peers. And Robert Walters certainly falls into that category. I just reiterate the point that I made before. We're probably not seeing the impacts of the economic imbalances and subdued growth at the moment. We'll probably have to wait until towards the end of the year. Whether this means that the recruiters will be exposed, as they have been in the past, is difficult to say.
Yeah, I know a lot of these groups do have, big investment plans, and the likes of Hayes have been investing for the last couple of years quite heavily as well. I suppose, there is that disconnect, as you say. It has been a strange labour market for years now, even pre-pandemic in the UK, where, employment rates held up pretty well in the face of, some stuttering growth at times. But right now, you look at some of these figures coming from Robert Walters, pay increases of up to 25% in some white-collar roles. It is quite hard, despite, tougher times coming down the track. It's quite hard to see that dissipating entirely.
I think the CPI peaked at about 13.5% at the beginning of probably in 1980 as well. It took a while from those problems during the 1970s to fully leach through. It's watch this space, I'm afraid. One hopes, anyway, for the sake of the country, that there has been a fundamental change in labour markets and they've become more resilient, perhaps as a result of increased globalisation. Who can say? But fingers crossed, and we'll come back to this in a few months, no doubt.
I was going to say, I suppose if you were looking at the defensive qualities of recruiters, you could make the argument that they're not just pure reflections of aggregate employment, in that they are able to pick specialties, like you're referring to, down the sort of white collar roles which are in demand, and they can sort of pick and choose, sort of duck and dive between whatever's hot at the at any given time, and presumably aren't going after some of the more cyclical hiring which may now be rolling off. So in that sense, they might be a bit more insulated, though obviously if they were hiring for crypto exchange roles over the last year, that's probably a tougher sell now.
Yeah, it's a good point. And Hayes, I think, it is pinning a lot of its hopes on tech in particular, presumably, as you say, not crypto, but targeting these niches makes sense, really.
Robert Walters did make the point, however, that they'd seen increased activity across all of their categories as well, temp and so on. So
yeah, I suppose it's interesting to think of some of the potential, structural factors at play as well. When you think of, right now you've got more early retirers, we've heard. You've got maybe more people out with health reasons. You've also got childcare, of course, is an increasing issue for a large part of the workforce, where it's becoming a bit more of a political hot topic as well, in terms of people not being able to afford to come back to work. So all these things are probably contributing to shortages, certainly in certain areas.
And we shouldn't forget also that more and more firms have outsourced this particular activity as well.
Yeah, I think some of the recruiters, they are quite keen to play up that angle, aren't they, in terms of the complexity of hiring decisions, particularly, I suppose, if you have a balance of temporary and permanent staff, and HR departments sometimes might struggle to do that themselves. But yes, we shall see. As you say, we do have full year results from Hayes and Page Group coming up next week, so we will be keeping a close eye on them and reporting in the next couple of issues. Okay, thank you for that, Mark. We are going to move on to this week's cover story, which is the Top 50 ETFs, our annual feature. Once again, funds editor Dave Baxter is in charge of the panel, who are tasked with looking at our list and making sure it's fit for purpose. Dave, what can you tell us, first of all, I suppose, about the structure of the list, just to outline it for people who don't know, we've got a selection of core building blocks, core ETFs. Then we've got some more niche offerings, satellite offerings on the side as well to complement them. I suppose the classic kind of basic first question is what does make a good ETF? What qualities are you looking for in sum?
Yeah, it's I suppose it's kind of thankfully much simpler than picking active funds. I imagine much simpler than stock picking in many cases, but it does come with complexities. So one of the key things is, people talk about cost, and ETFs do tend to be very cheap, and you would like it to be cheap. So for example, if you're going for a really mainstream fund like a FTSE 100 tracker, you don't really want to be paying more than, say, something like 0.1%. And the cheapest fund in that category in our list is 0.04%, so really kind of rock bottom prices. But you also, if you can, you want a kind of large funds because that tends to bring decent liquidity, which will keep your kind of trading costs low. I mean, your overall cost of investing is lower. But perhaps an overlooked point is simply what you're tracking as well. I mean, this is pretty straightforward. Again, if you are focusing on, what we've patched the core funds, so the S&P 500, the FTSE 100, even perhaps less closely watched areas like Europe and Japan, there are kind of well-known indices that you can track. But when we're looking at some of those more niche options and kind of satellite holdings, you might be looking at things like we have a bunch of kind of factor ETFs focusing on value, minimum volatility. We have some interesting dividend ETFs. But in those categories, there are some really significant idiosyncrasies, and particularly, say, in the dividend space, there are choices to be made over the kind of the approach you back, and what kind of trade-offs you're effectively taking with that choice.
Yeah, I think that's quite a feature of the list this year, isn't it? Some of the discussion, a bit more detail of those trade-offs and considerations, things to look at, because it's not as simple as saying, right, I'll choose one S&P tracker, one FTSE tracker, and then two or three others. It's not a countdown style, two from the top and three others. But this has been quite a dramatic year for markets, dramatic 12-month period. So I think it's also important to reflect on what's worked, what hasn't. Have ETFs shown their worth? How people might be thinking about these things now in a slightly different context. Certainly in a falling market context nowadays. Yeah. How do you sort of see that change? Maybe that interest in particular niches evolving, or also how do you sort of see people reconsidering perhaps what they want from ETFs and what they can expect from them?
Yeah, it's an interesting question. I guess we try to within the list there is, because they're so broad, ETFs, or they can be, and they cover a lot of areas very well. We can accommodate for quite a lot of different niches and particular situations and preferences. So I guess kind of we have a few kind of different things we've been trying to do. So we've been trying to accommodate in the last, even a couple of years ago, for some concerns about inflation and rising rates and that kind of thing. So we have some more perhaps defensive bond funds. We have, I mentioned kind of factors. We have some value funds that have kind of held up, if not fantastically, they've held up better than kind of other parts of the market. But I suppose, it's interesting if people are kind of considering things now. I mean, you don't really want to be selling out of a falling position, classic behavioral risks there. But there are parts of the list that have targeted really in vogue areas in the past, whether it's kind of thematics or whether it's, we have a NASDAQ 100 ETF in there, which has, suffered a huge paper loss in the last 6 months to a year. But I guess it all comes down again to those kind of unglamorous but useful portfolio construction ideas of kind of getting your base exposures, and then you've got some diversification there, whether it's kind of across equities or equities and a bit of bonds. And then, like I said, those more niche positions, there are a lot of idiosyncrasies that you just need to be aware of in terms of how your performance is going to be affected. So just to turn back briefly to the value ETFs, they have done well, but they do have kind of characteristics that potentially hold back how well they could do. They tend to stay kind of relatively neutral with the underlying index in terms of their sector weightings, and that means that they can't suddenly go, oh, energy is shooting the lights out, we're suddenly going to have a 40% weighting in energy. So instead, they stay much more balanced, and they're not going to give you those kind of really niche, massive gains that something like a sector fund would. But then equally, you're not taking as much risk.
Dave, I just had a question on the on just to return to price as well, which you alluded to, and obviously it's one of the chief reasons people buy into ETFs. We kind of previewed one of the picks in last week's ideas section with Alex Hamer wrote up the gold fund, which you've selected this week, and I noticed their fees have steadily come down over the last few years. Is that a theme? I know that's a very long-term theme in that fee compression is just, presumably it's only heading in one direction. Has that been noticeable in the year-to-year comparison you've made this year?
Yes and no. So in the you mentioned the Invesco Physical Gold ETC. The gold fund providers have been in this huge price war in recent years, and we mentioned that. Let me try and draw it up. If you look at the prices of that fund's been the list for several years. It's always been this kind of price war with a rivals iShare funds that is also very liquid, also kind of very competitive on fees. And they've always been trying to undercut each other. But I looked back over something like 3 or 4 different years of the list, and every single time it has come down. So in certain areas, yes, you are seeing that fee compression. But what's actually interesting, at least within our list, is, sometimes with this list in the past, in, course of several years, you've seen some major overhauls, and that's sometimes been because of lots of fee wars. But in our list this year, you haven't really seen much of that. You've only seen 2 or 3 instances where fees have come down. So I suppose perhaps, this is only kind of a small subsection of funds, but perhaps you are getting to a point where with the kind of more mainstream funds, like I said, they are now really cheap. So perhaps there's less room for that to come down. And what's interesting on the other end of the scale, you have very specialist funds like thematic funds, and then you have, for example, we have some quite niche plays, like you have a Japanese small cap fund. They tend to still look fairly, relatively expensive for ETFs, and that's because you're not seeing the competition there because it's quite niche.
Yeah.
So perhaps for now it has slowed down, but you might expect over time things like ESG and thematics, as you get more providers trying to capitalize on demand for that, as long as market rotations don't completely trash that demand. Hopefully you should again see another wave of price competition over time.
Yeah, I think the idea of the piece in general, isn't it, is to give people the best option in each area. So, of course, you can put together an entirely ETF-based portfolio. I imagine most of our readers would use them as complements to active funds or individual shares, of course. And this really gives you, a list of choices from each area, imperfect as they occasionally may be, as areas for selection. But it's I think really a valuable tool and a reference point for people to have. So yeah, do look out for that this week in the issue. Let's shift now from building blocks to something a little bit more complicated, which is unlisted, unquoted assets, if you will, specifically in the news at the moment due to the travails of Chrysalis Investments, the investment trust, which has been a very popular play, but has really struggled, to say the least, in the past few months. This is an investment trust managed by Jupiter managers nowadays. It was Merian. Of course, Jupiter then acquired Merian. And, it's quite a common story. It's in many ways a microcosm, I think, of what we've seen in markets in general over the past few months, insofar as these really elevated valuations, even for private assets, have started to be brought back down to earth and have come back down to earth very quickly in some cases. And that has caused quite a lot of pain for the holders. Julian, our deputy companies editor, has been following this closely over the past few weeks, and you've written on this in the magazine this week, Julian. Do you want to sort of talk us through a little bit about, Chrysalis and what's happened there of late?
Yeah, thank you, Dan. Yes, it's a slightly convoluted story, but over the last few months, there's been some concerns over how fund managers have been putting assets into unlisted entities or via listed entities, if that makes any sense. So Chrysalis was a specialist fund manager that had a lot of private companies in its portfolio, including things like Klarna, the sort of buy now, pay later specialist, Starling Bank, relatively quite well-known brands, as it were. But the interesting part of the story, I suppose, was the dependency of Jupiter Fund Management on Chrysalis, which is something I hadn't picked up on before particularly, but I'm sure Dave Baxter will have covered the story in more depth. But it seems like Chrysalis was providing quite a large proportion of Jupiter's per valorum fees, otherwise the sort of fees for performance that the fund manager was earning. And if you look at the annual report, Chrysalis is mentioned 25 times just in Jupiter's annual report. So it seemed a very high level of dependency given the relative size of the two entities. But the whole background to this really is that Jupiter itself is going through a period of great instability. So they've just changed the chief executive, who decided to retire at the age of 51. He said he was going to spend more time on the beach, I believe, was the quote. And they've brought in the chief investment officer, a guy called Matt Beasley, to replace him. And it seems to me like he has a great deal to do in order to rebuild that position there at Jupiter. And it's going to take quite a lot of work, I think. And the jury is out on whether that ultimately will involve a sale of the company, or a major reorganization at the very least. I would have thought would be the minimum that the market would expect in this case. But it is a cautionary tale. We have been here before in the industry. So, the Woodford funds all end up in. There was a lot of controversy around the use of unlisted, private assets in those funds, and it seems to be that sometimes the temptation to take the easy performance win is too great. To resist, and that's why these things tend to sort of repeat. But no, it's a very interesting, a very sort of in-depth story. But we will see what happens with Jupiter over the next few months.
Yeah, I think Jupiter. The sale rumors have been there for a while, and not unsurprisingly, given it has suffered outflows for several years now, and is ostensibly a strong brand, but they keep waiting for that bid to come, and it hasn't yet. So we'll see there. But I think you're right about the private assets as well. I mean, this is an area I covered a bit in the past, and even when the Woodford issues with Patient Capital Trust notwithstanding, this has been an area which a lot of asset managers have really tried to get involved in the past few years. From the likes of Scottish Mortgage down, talking about private markets, as we've all been told and all heard so much about. That's where a lot of the value is. Companies are coming to market later, so you really need to access these illiquid assets to make many of the gains. And the Chrysalis Trust is quite a late stage investor in that front. It's not a venture capital, early business. These are businesses which, in theory and in practice, in some cases, do then IPO and realize some of those gains. The problem here, twofold, I suppose, from a reputational point of view. The problem was that the performance fee was granted in around, I think, October last year on Chrysalis, which was obviously very high, right at the top of the market. A lot of that went to Jupiter. Since then, things have gone horribly wrong. A lot of the valuations come crashing down. And yeah, there's a reputational issue. There's also, I think it's fair to say, an issue with those private assets and how they're managed, really, and how a fund manager does rely on those in their portfolios. If you think of a situation where, not just in terms of taking the performance fee, but in terms of these late stage companies, Klarna's valuation went up to about 45 billion in a matter of years. That's based on these big backers, Goldman Sachs, etc. And Chrysalis was very happy to ride that wave and see Klarna account for a bigger and bigger part of its portfolio. Only for, when the tide has gone out, that valuation's been slashed. I think suggestions are the latest fundraising might be at 6.5 million. So, barely a tenth of what it was just 6 months ago. And that's obviously going to have big repercussions when you've let it become 15% of your portfolio. Dave, I know you've looked at this as well.
It's interesting. Just you mentioned the position sizes. As you say, they've had big stakes or big exposures to Klarna and to Starling Bank, and that's perhaps a slightly unwieldy portfolio. That kind of fascinates me because as we were actually discussing earlier, if you're looking at earlier stage investing, then there is that argument about asymmetry that you might have a lot of losers, but then you'll have some big winners. And hopefully you run those winners hard and you keep running, and then that kind of drives your performance. So it's interesting to, I guess, kind of ask about whether those portfolios should be less concentrated in a more mature part of the market. But what's interesting is if Chrysalis sits in a sector called growth capital, which I suppose broadly refers to that, what you're talking about, kind of companies that would maybe hope to have an IPO a few years down the line and are more of a mature private company. But if you I was looking at some of the other trusts that sit in that sector. So you have the ex-Patient Capital Trust, and that's equally quite unwieldy, has really massive exposure to Oxford Nanopore. And then equally, perhaps isn't a like-for-like comparison, but Seraphim Space, a relatively new entrant to the market, that again actually has a really big position in its biggest holdings. So yeah, I don't know whether that kind of very concentrated style does make sense even in that mature part of the space, or whether there is just too much doubling down on kind of those most exciting stories, and then they just kind of let it run away from them. But maybe that's kind of one lesson.
Well, they're almost predicated on being IPO'd. I think that's where they tend to go wrong, is that as soon as the market turns, you are then stuck with illiquid assets on the investment balance sheet, and you can't, other than sell the trust shares, you can't get out of them. So it's why they're now trading at such a huge discount to net asset value. I mean, the people have just given up on it. And they've also been actively shorted. I think that's the other thing that they've run into. The other issue they've run into, that people have seen these big positions and taken active short positions against it. So yeah, so in the end, Jupiter gets battered from all sides really. But I mean, in a sense, it can't get any worse. I mean, the new guy has to come in and clean it up, and they'll either fatten the business up or sell it. I think that'll be the next thing we see from them.
Yeah, well, I think with Chrysalis, to me, part of the risk is that the way the Mark II market, or the Mark II to whatever you want to call it, is it could get worse insofar as that big Klarna fall hasn't been realised yet in the portfolio valuation. They came out with one a couple of weeks ago, which has prompted some of the latest sell-off, but that was still valuing Klarna, which is about 15-20% of assets, or it was still valuing that at about 30 billion. So they said there'll be more markdowns to come, and there certainly will be if it's marked at 6.5 billion in 3 months' time. So you've got to make sure if you're invested in that trust, you're aware of the delay there as well. It's all very well being in something that isn't traded and isn't subject to daily volatility, but that volatility can come through all at once on those updates, and if you're not careful. Alex, I know you a few weeks ago we were talking about that VC mindset, and which again is slightly different from Chrysalis. The buy 10 and one will pay off. But I think we can stand by those opinions. There are still things to learn from that kind of mindset. But this is cautionary tale on the other side.
Yeah, totally. And you look at I was just looking at the other two mentions we've made of Jupiter Fund Management in this issue. One is in the Ideas Farm. They're one of several companies which has just hit another 52-week low, and in the No Thought portfolio, they are one of the top 10 or top 20 rather highest dividend yielders. So obviously, so another way of saying that their valuation is completely bombed out. I mean, in fairness to them, they mid-market fund managers, they have to have some differentiation and story to tell. And I mean, all asset managers, as Julian has obviously no doubt has been following in the last few weeks and written about a lot, have suffered, but some are going to suffer, more in periods of extreme sell-offs, and when the funds that they've that they've benefited from very recently have suffered so badly. So, yeah, I mean, it's not a strategy just to say we've got to do something, but that is the legacy that they've been left with. And it's not easy to see necessarily where they go from here. The Newman note, just got it in front of me, reacting to the change in CEO, said they don't envisage any significant change to the group strategy or outlook as a result of Matthew Beasley coming in. I mean, they're corporate broker, so you'd hope they would have some insight into that, but it's not necessarily that inspiring a comment, really. Yeah, I mean, I don't know where you'd go from here if you're a Jupiter fund management investor.
Yeah, it's difficult when, as you say, those funds are in outflows, as with all asset managers, until those inflows return, the sentiment isn't going to return. And how do you get those inflows to return?
Yeah.
Good management, good distribution, but, easier said than done.
You might be just better off buying a leveraged long index tracker fund. I don't know if we probably aren't recommending any of those in the ETF.
Not right now, no.
On which note, we have reached the end of this week's podcast. So thank you to Alex, to Mark, to Dave, and to Julian, and thank you to you for listening as ever. We'll be back next week with another Companies and Markets show. Goodbye.